Welcome to The Upside, focused on making you a better investor. Now, I'm not a professional investor by any means. I'm just like you, an interested observer looking to learn more about investing and how I can stay ahead. That's why we're bringing you this weekly series. We'll provide you with insights and information that goes beyond the headlines, bringing in experts from all over the financial world, from portfolio managers and investment professionals to retirement and tax experts and everything in between. We want to help you stay on track to becoming a better investor. Welcome to the show. I'm your host, Emily Nuevo. On today's show, we're talking all about the building blocks of retirement. What is the best retirement plan for yourself? How can you get started on building a strong foundation of income for your retirement years? Fortunately, there are many retirement strategies out there for Canadians, and joining us on the show today to provide information on those choices is Michelle Munro, Director of Tax and Retirement here at Fidelity. Michelle is a tax and retirement expert who travels across the country, meeting with financial advisors and investors. Michelle speaks about retirement, estate planning, personal finance, and she's also co-author of Fidelity's annual retirement report. Michelle, welcome to the show. So happy to have you here.
It's a pleasure to be here. Thank you, Emily.
Now, Michelle, we know retirement planning takes a lot of thought, strategy, and information, and we all want to live comfortably when we retire, which is true of all Canadians. But we also know that it takes a significant amount of money to be saved to support your retirement lifestyle. So today you are sharing 4 main building blocks to retirement planning. What is your first main building block that you want to share?
I want to start with Canada Pension Plan and Old Age Security.
Perfect way to start. What is the difference between the two income systems and what is the flexibility of each one?
Okay, we'll start with Canadian Pension Plan, CPP. You probably notice on your pay stub, every pay period, there's a withdrawal that comes out and that gets remitted to the government. So CPP is funded through your employment earnings. And so there's the employee portion as well as the employer portion. Now, Old Age Security, that's a government benefit that's paid for through the general income tax pool.
Okay, so what is the age eligibility of CPP?
Okay, so normal retirement age is age 65, when you'd be entitled to a benefit based on the number of earnings, based on the number of working years and the earnings during those years. Currently, the maximum benefit is about just under $14,000. Now, for CPP, you can take that actually before that standard retirement age of 65 and as early as age 60, but you won't get the full payment at that point. The government will decrease that payment by 7.2% per year before age 65. So you'd get about, if you took it at age 60, about 64% of the amount you would otherwise receive. Now on the flip side, you can also delay receipt of CPP until age 70. And the government will give you an increase of 8.4% for each year you delay. So if you delay it to age 70, you'd get 142% of the amount you would otherwise receive.
Okay, I didn't know about those two age options. Curious though, is there a break-even amount?
Well, you're thinking about, is it better to take a smaller amount sooner or a larger amount later? And really it depends on how long you're going to live. And with life expectancy increasing in Canada, it's generally better to delay receipt.
Okay.
Now, most Canadians, almost 50%, take CPP at age 60.
Right.
And really the reason is because they want that cash flow. So working with a financial advisor to figure out, well, if you delay CPP, what's your alternative sources of cash flow for those years?
So let's switch gears and talk about OAS. I want to know the benefit amounts for OAS.
Okay, so Old Age Security, you can take that as early as age 60. So there's no option to take that, at age 65.
Okay.
So there's no option to take that earlier than age 65. And the benefit amount is just a little bit over $7,000 per year. Now, and again, that number changes every year. It's indexed for inflation. You can delay receipt of that up to age 70, and you could get an increase of 7.2% per year if you delay beyond age 65.
Okay, great. Let's move into the second block. What is the second sort of main building block to retirement planning? I know it has to do with workplace savings, right?
Workplace savings. So you're thinking about something where your employer is also helping you save for retirement. So there's two types of pension plans, a defined benefit pension plan as well as defined contribution plans, as well as there could be group RRSPs.
Okay, so what do I need to know about DB plans?
Okay, a DB, defined benefit plan, you're using the lingo.
I like using the acronyms.
Okay, so a defined benefit plan. Typically, the employee and the employer are making contributions to the defined benefit plan. Now, as the name suggests, it's the benefit that you receive in retirement is guaranteed. Okay, so it's defined, it's guaranteed, and the employer has the risk of ensuring that the investments that are made during the period are sufficient to pay you out your pension benefit during retirement.
And if we can just go to the flip side, what are the what do I need to know about DC?
Okay, DC, defined contribution plan, is the as the name suggests, it's the amount of the contribution during the employment years is defined, and that could be the employer portion as well as the employee portion. And then the risk is now shifting to the employee. Is there enough being saved? Is it earning enough growth and investment earnings? And so will there then be enough for the the receipts, the benefits during the retirement years?
So Michelle, what do I need to know in terms of key differences between the defined benefits and the defined contributions?
Okay, so the defined benefit plan is that it's the pension income that's being received by the employee is guaranteed during the employee's lifetime, whereas defined contribution, it's the contributions that are made during the working years that the employee and employer are making.
Okay, great. Now, the third building block I am familiar with because we've done other shows on these two different income systems. So the third one has to do with registered accounts, TFSA and RRSPs, right?
So registered savings plans and tax-free savings accounts.
Okay, so what should we begin with in terms of our, I guess, intention or plan with these two systems?
So think about registered retirement savings plans, RRSPs. Those are intended for long-term savings for your retirement, whereas tax-free savings accounts are much more flexible. Now, I would certainly encourage people to think of them to use them for their long-term savings, but because they're so much more flexible, they could be used for other purposes as well.
And like I said, we've talked about this on other shows together.
Right.
The flexibility is amazing, and you know, there's really no, I would say, wrong way to go. But in terms of contribution room, can you speak about that for both?
Okay.
Yeah.
So, registered retirement savings plan is based on employment earnings. Okay, so it's up to 18% up to a yearly maximum. Whereas tax-free savings account, every adult gets our TFSA contribution room.
Yeah. Okay, so can I get a tax deduction when it comes to my contribution?
Okay, so when you're making an RRSP contribution, you can get a tax deduction for making that contribution. Whereas a tax-free savings account, there's no tax deduction associated with that. So we say you're making that TFSA contribution with after-tax dollars.
Okay, so let's talk about the RRSP, because if I've made a contribution in 2019, can I get, do I have to deduct that from my 2019 tax return?
Well, most people think that they do have to, but you don't have to. So say you've made your RSP contribution in 2019, you don't have to make that deduction on your 2019 tax return. You could delay that deduction to a future year. And here's why you might want to consider doing that. Say you're in a lower income tax year in 2019, but expect to be in a higher income tax year in 2020 or beyond. Well, you want to get the maximum deduction for that contribution. And because we have a graduated tax system, the higher you earn, the higher taxes you pay, you'd want to delay that deduction into a later year.
Okay, so there are some scenarios where people have missed contributing to their RRSP. So what if I've missed contributing to in one year? Can I then contribute, later, and how much?
So say you've missed your contribution for 2019, you can make that contribution in 2020 or a later year, and that applies for both RRSPs and TFSAs.
Okay, perfect.
Yeah.
Answering all my questions here, Michelle. It's great. So another question, what type of investments can I invest in this particular account?
So both RSPs and tax-free savings accounts, a wide variety of investments. So most people think about your publicly traded securities, stocks, bonds, mutual funds, GICs, can be invested.
Okay, but how are my earnings and growth taxed in these accounts?
There's a slight difference. Once you've made your contribution for an RSP, so you've got your deduction, we say it grows on a tax-deferred basis, meaning you don't pay taxes on the income or growth in any given year. Okay. You actually pay taxes when you make that withdrawal some year in the future, likely retirement. And then the withdrawal, whether it's the original contribution, the growth, the earnings, that withdrawal is all taxed as ordinary income.
Okay.
Oh, let me compare that to tax-free savings account.
Right.
So as the name suggests, it's truly tax-free. So you're making the contribution, you don't get the tax deduction, but it grows tax-free. And when you make that withdrawal, and it doesn't matter if it's the original contribution, the growth, the investment earnings, what have you, that withdrawal is tax-free.
Okay. So here's a question though. If I want to withdraw some of the amounts or some of my money in both an RRSP and TFSA,
right?
Can I then put that money back? Can I then recontribute?
Right. So if you make a withdrawal from your RRSP, now there's a couple exceptions, say home buyer's plan or lifelong learning plan.
Oh, okay.
But generally speaking, if you make a withdrawal from your RRSP, you cannot recontribute that in the later year. Whereas tax-free savings account, if you make a withdrawal, say in 2019, you can recontribute that in 2020 or another future year.
So you've laid out the similarities and differences between the two. So is there a better one of the two? If you could lay it out, if you could choose.
Okay, if you could choose. Well, let's start with about somebody who's early in their career, okay? And probably my best advice for them is to start saving. Start that discipline of getting it organized, set up the monthly, whatever coincides with your payroll, making a contribution to either or better both. But let's look at it a little bit simplistically and looking at the math behind it. Typically in the early career, someone's in a lower income bracket, so they're paying lower taxes. And so they're not as concerned about getting that deduction in the early years. So a tax-free savings account might be preferential over a RRSP. Whereas somebody who's more in their mature years, their later earnings years, well, they'll be looking at their higher earnings, so they're going to get that higher tax deduction on making the RSP contribution. And then when they're in retirement, they're actually typically in a lower income tax bracket, making that withdrawal, so they're at a lower tax rate. So on that withdrawal, on the RSP income, paying lower taxes.
So it really is, start early if you can.
Absolutely.
And you're readjusting as your sort of, next chapters in life go on, right? I mean, it's all different, like you said, earlier in your career and as you're approaching retirement age.
Right.
A lot of information there. If we could wrap up this one block, what are sort of the key takeaways you want to leave with our investors and viewers on the two?
Okay. Thinking about RSP, people like the instant gratification of getting that tax deduction and usually a refund that goes along with it. And I like the RSP because it's really the intention behind it is thinking about long-term savings and looking at it together with the TFSA, thinking about, well, there's a lot of flexibility with the TFSA. So thinking about what makes the most sense for you.
Okay, great. Now into our last building block. Michelle, I know it is for non-registered accounts. Can you define what non-registered accounts would include?
Okay. Non-registered accounts, they're typically called an open account or a taxable account, and they would be used after you've maxed out your RSP or tax-free savings account. Now, you can contribute as much as you want to a non-registered account.
Definitely,
now,
if you have
because
that
it's
option,
taxable, the income is taxable as it's earned, and so you're paying taxes on that every year. When you sell it, typically there's a capital gain associated with that, so you trigger a capital gain and pay taxes when your investment's disposed. But you can recontribute as much as you want, whatever you want, so there's a lot of flexibility that goes along with that.
Now, are there other types of income in retirement that we need to know about?
Now, other types of income, what we're seeing is people could have rental income. So a property, they're renting out a condo, for instance, so that could generate some income for them. We're also seeing that people are actually working in retirement a little bit more. And a little bit of the definition there is like, well, if you're working and retired, are you actually working? It's the intention behind the working towards something that you feel passionate about, something for pleasure and enjoyment. It's reasons to thrive, not really to survive anymore.
Yeah, I'm glad you mentioned about working in retirement years. I know some of that information is included in our annual retirement report, which you promptly have here. But like you said, retirement now is a different picture for everybody. People are still working part-time, some are not. Like we said at the beginning of the show, plan early, and you know that you have to save a significant amount if you want to, support your lifestyle in the retirement years.
Right. So thinking about it very holistically, take a financial snapshot, if you will. Where are you at? Looking at what are your investments, what accounts are they in, and thinking about what are your goals. Are you thinking about retirement, saving for a down payment on a house, or is it for a vacation or a new car? And then what's the timeline with each of those goals? And then thinking about, well, which account makes the most sense, and then the investments. So thinking about it very holistically and working with a financial advisor who does this all the time can really help you make smart choices today to give you more options in the future.
Michelle, as always, I want to thank you for being on the show and sharing, your insights and information on a very valuable topic. So thank you so much for being here. Really appreciate it. Thank you for watching, and don't forget to tune in weekly as we delve into more investor topics. Now, we always welcome your feedback and comments, so please email us at fidelity.connects@fidelity.ca for your suggestions and comments. Thank you again for watching, and we'll see you next time.